We'll take the discussion forward with Niket Shah, who's joining us from Motilal Oswal AMC, the new CIO there. Niket, good to have you on the show. Also, best wishes for your role. Let's start by understanding your framework, the way you are approaching the market. Surely, I mean, the business is well established, but your own personal, landscape, how do you analyze it in your own view?
So I think our view on market has always been constructive post-COVID, and we continue to remain constructive. But I think one should really expect that this is not going to be a one-way ride for the next 5, 7, 10 years. There are going to be bounds of correction, and I think every correction is going to be used as a buying opportunity by us. What our thought process has been that we have identified a lot of themes which we want to play this cycle for. So post-COVID, we went overweight on IT. A couple of years back, we were overweight on capital goods, which is now the darling of the street. And last year, earlier in the month of March, we went overweight on telecom, which we believe will be the theme for the current year. So I think it's very important to identify themes ahead of the curve, be positioned rightly in the right stocks within that theme, and let the time pass by, and then I think the themes will have to play it out. And if those themes play out the way we think, and I think there's a large amount of opportunity to be made even in this market. So while there are pockets of froth in the market, but I think we should not paint it with the same brush that everything else is expensive. So there are opportunities in the market today where there is value, and we are actually looking at some of those spaces.
Interesting, very well said, I would say. And also, I'm quite intrigued to look at IT software related 15% weight in your large cap fund. And the top 10 holdings out there show names like Coforge, Persistent, among others. I want to talk to you about IT, especially the mid-tier IT, which may not be very cheap, at least by the looks of it, but offers very high growth. Some of them are doing strategic acquisitions, which they are saying that they are accretive. Some are operating very niche areas where margins are good and the business slowdown is not as much as some of the large cap IT firms are witnessing. How do you like this pocket and what's your rationale here?
So I think, maybe 1.5 years back when one of the large cap downgraded its guidance, and entire IT went for a toss. That's the time when we really went overweight back on IT. I think the rationale is very simple. We believe that the AI is the next big wave for Indian IT companies, and it is going to come much faster than what we all think of. Our sense is sometime in the second half of this year, you will start seeing traction for a lot of the Indian IT companies as far as AI is concerned, and it kind of builds it from there on for the next 2 to 3 years. Now, within AI, you really have to figure out whether you want to play the large cap part or you want to play the mid cap part. There are some businesses which will get impacted because of AI, and obviously for some companies, there is going to be cannibalization of revenues. For some companies, this is an incremental opportunity. So we actually have to figure out that which are those companies where there will be incremental opportunities or incremental revenue growth coming because of AI, and are they positioned ahead of the curve? In our opinion, some of the mid-cap ITs where we have invested, we believe they are positioned ahead of the curve. Whereas if you look at some of the large cap, there can be some cannibalization of revenues. Second point is growth. I think we are all chasers of growth. And we believe that earnings growth drive markets and stock prices as well. So hence, I think growth in mid-cap IT is likely to remain higher, at least for the next 3 to 4 years, as compared to some of the larger cap names. So that's the short answer to why we really like IT.
A very interesting name out there in your portfolio. But clearly, I want to understand some South-based large groups have now incubated their companies as holding companies, where it has very meaningful roles to play in holding other companies which are operating assets. And in the new avatar, as a new version of it, these South-based groups, the Murugappa group, etc. Where do you see the trigger happening? Is it the re-rating which is possible here, or is it the companies which they are holding in their portfolio, they may become very large? What exactly is the trigger?
So I think both of them. I think some of the companies, which is the group that you mentioned, are part of our portfolio. I think they started with, first of all, improving their base business. Right? The base business margins are far lower. They have moved to a very respectable number. So that was the first round of re-rating. The second round of re-rating is the segments that I really want to get into, like EV as a category, medical devices, mobile component manufacturing, which is, I think, the largest theme to be played for the next 2-3 years. And I think that has been the second round of re-rating, where they have made some early movers. They have made some early moves in that segment. And I think we will see scale up of that happening over the next 2 to 3 years. And last but not the least is the holding company. They hold large stake in some of the cap good names, which was bought during the COVID period. And that market cap of some of them have actually compounded meaningfully. And that is also adding value to the stock price. So our view is that this is a business where you should not look at in only as a auto and company as such, but you should look at more as sum of parts. And I think if you add some of those parts, each and every business, the size of opportunity is extremely larger. And we believe that is likely to play out in the next 3 to 4 years. All the themes which are now being looked after for the next 3 to 4 years, whether it's mobile component manufacturing, whether it is EV, or whether it is medical devices, whether it is capital goods, I think this is one company which has all those components in it. So that's, I think, the clear view that we have on them. And I think it's run by probably the best CEO of India right now.
The closing part of your answer was a clincher. Good one. I don't disagree with you, I would say. We've seen his capabilities in previous avatars as well. Okay, let's move on and talk about the most talked sector in the last 1 month, and that has been telecom. Well, it's been a secular wealth creator so far, but many believe that now new fresh growth triggers are at the horizon, be it tariff hikes, be it resurrection of one player, which was almost being pushed into, non-existence, has come back. What are your most convincing triggers for owning such a large weight in telecom?
So I think if you look at telecom has also gone through its cycles, right? If you look at the last, say, 12 or 14-year period, say from 12 to 15 or 16, telecom actually went through a large capex cycle, right? And then you had a large guy coming in the space in 2017 and impacted the industry from a P&L standpoint as ARPU rates really corrected. And what we've generally seen that in that 4-5 year duration, everyone was struggling to figure out that how are we going to make our interest payment and debt payments, right? From that period, I think, and then you obviously have a 5G capex, which is obviously played out in the last 3-4 years. As we look at the next 5 years, few things are likely to happen. First, I think we expect AGR prices to move up meaningfully from current levels, right? So that will give them significant amount of EBITDAs for them to make repayment for their debt, which starts next year as far as government of India is concerned. Now, the number 2 and the number 3 player actually have to make payments to government starting next year. And there's only way to make payments to the government, which is at 30,000 or 40,000 crores on an annualized basis, is by improving your EBITDAs. And the only way that you improve your EBITDA right now is not volume growth, but pricing, right? So pricing has to play out in this year and next year cumulatively for them to be even coming closer to paying that entire amount. If not entire amount, at least partial amount, at least for the number 3rd guy. So I think the pricing will be the first big trigger as such. The second is the migration from 2G to 4G. Still, India has a large amount of 2G customer base. I'm not saying it will go to zero, but it still has a reasonable amount of customer base. And that customer base every year keeps migrating to 4G as such. And that, I think, is again an incremental growth for EBITDA as such. Last but not the least, I think the next 5 years, maybe 26 to 30, the capex intensity in the business will come off. You will see most of the companies being 5G ready. In fact, they're over ready in our sense in the next 1 or 2 years. And then you don't have 6G coming in. So it's going to be a 4-5 year window where your every earning that you're going to make is essentially going to go towards repairing a balance sheet. So from a period of last 14 years, our balance sheet deteriorated, then P&L deteriorated. Now you will see P&L improvement first and then balance sheet improvement later. So that's how we're looking at the next 3-5 years for telecom as such.
We all saw that number recently, right? A report saying India, there's a massive demand supply mismatch which has occurred in the air conditioning space. And, air conditioning, there are some direct plays, consumer durable plays, the leaders I'm talking about. Then there are also some job work or contract manufacturers of room air conditioners. Now, this space has been doing very bad for last several months. Now, things seem to be turning back. How long or durable do you see this? Are they coming out of a cycle going forward, and how things look here in air conditioning space?
So I think as we're looking at this year, clearly, I think growth is coming back as far as AC segment is concerned. But I think the size of opportunity, the profit pool of the AC business as such is not very, very large, right? You really need to get into other businesses like consumer durable business, having a new brand there, and looking at a larger market share play there. I think that is the clear excitement rather than just investing in pure AC business. So if you look at in India, most of the listed names, while they have AC as a large category for them or large profit pool for them, but I think most of them do realize that you can't survive a business or you can't grow at 25% for the next 10 years by only having an AC business, because the profit pool itself is less than 1,000 crores for the whole industry as such. So you need to have other businesses in place. Now, some companies might have cables business, some companies might have durable business, some companies might have something else, but you need to have a diversified portfolio. And I think most of them have now got into a diversification thing. And I think our view is that the diversification is where the excitement is going to get created in the next 2-3 years.
Great chatting with you, Niket, and I look forward to having you more often from here on as well. Thank you so much.
Thank you. Thank you so much for your time.
That was Niket Shah of Motilal Oswal AMC.
If you like this video, then like, share and subscribe to ET Now.